Finally, it's time to talk about the Nasdaq ETF because most Singaporeans who want to invest in the Nasdaq 100, they simply buy the QQQ. But in 2026, that may no longer be the best choice. There are now cheaper alternatives charging almost half the fees, while Singapore investors also have Ireland domicile options that can reduce the US estate tax concerns. So I'll be comparing 6 Nasdaq 100 ETFs today, and that includes some that you may not even heard of. And surprisingly, the cheapest ETF is not automatically the best ETF for every Singaporean. But before we compare the ETFs, we first need to clarify what are we actually investing in. Because many investors, they describe the Nasdaq 100 as a technology index, which is not technically correct. So let's correct it, right? What is the Nasdaq 100? The Nasdaq is a stock exchange just like the New York Stock Exchange. The Nasdaq 100 index tracks the 100 largest non-financial companies that are listed on the Nasdaq exchange, and it is modified market cap weighted, so the largest companies generally receive the biggest weights. The important word here is non-financial. And if we look at the yearly performance, the most recent bull market in 2023, it made over 50% in annual percentage gains. And the most recent bear market in 2022 lost over 30%. So that is a very big upside and drawdown, correct? So you need to have a big heart for it. And to be super clear, the Nasdaq 100 index does not just include companies just because they are technology focused. It selects large Nasdaq listed companies while excluding financial businesses. However, many of the world's largest technology and growth companies by market cap happen to be listed on Nasdaq. For example, Walmart is not a tech company, but they listed in Nasdaq and is quite a large cap and included in the Nasdaq 100. And this is why the index is heavily exposed to technology, communications, and consumer growth companies. So the Nasdaq 100 is not technically a technology ETF. It is better described as a concentrated large cap growth index that happens to be dominated by technology-related companies. And hi, if you're new here, my name is Chris Chong, an ex-chartered accountant, now a personal finance YouTuber, and do follow me on my Instagram since I only have 4,000 followers to share more financial insights. Now, let's talk about what does the ETF do, because you cannot buy the Nasdaq index directly. Instead, you have to buy an ETF that attempts to replicate the index. And the top 10 components by weight as of 30th of June 2026, you'll see familiar names like Nvidia, Apple, Micron, Microsoft, and AMD. The main differences between ETFs tracking the same index are like the expense ratio, the trading liquidity, the beta spread, the fund size, the track record, accumulating or distributing dividends, and the fund domicile, and whether there's US estate tax exposure. So let us start with the first ETF, QQQ, the default option. And this is the Invesco QQQ, launched in 1999, one of the most actively traded ETF in the US. Expense ratio is 0.18%, market value close to 500 billion. And my take on this ETF is that for most long-term Singapore investors, QQQ is probably not the best option because you're paying slightly more, mainly for the liquidity and the options ecosystem. So it matters more for traders and people who are interested in options trading, but far less if you are buying monthly, like a DCA, or for people holding for 10 to 20 years, because it is not the cheapest. And we move on to the second option, which is QQQM. This is the established lower cost option compared to QQQ. Now, QQQM listed quite recently in year 2020. It tracks exactly the same index with a cheaper expense ratio of 0.15%. Market value around $100 billion. And before 2026, QQQM was an easy default recommendation, and I used to hold it since it was cheaper than QQQ. But the competition has become far more interesting, and I'm sure some of you may not even know there's even a cheaper option, which goes on to the low-cost challenges, especially this year, and that is QNDX, the State Street Nasdaq 100 ETF that launched in June 2026. Gross expense ratio being 0.1%, assets under management over 200 million US dollars. And also one more being IQQ, the iShares Nasdaq 100 Index, which also launched quite recently in July 2026 with a gross expense ratio 0.12%, but now they're having a fee waiver with a net expense ratio reduced to 0.1% until 31st July 2027. Net assets of over $350 million. So If you ask for my take, I feel that QNDX is currently the cheapest permanent US listed option, while IQQ matches it temporarily, but the stated gross expense ratio is 0.12%, just slightly more only. And both funds are really new with a tiny assets under management and unproven liquidity yet. So if you're trying to save 5 basis points versus QQQM, that saves you about $5 per year for every 10,000 US dollars invested. So it's not really worth rushing to switch from your QQQM to the newer ETFs just to save that few basis points. But you have to note that all these US listed Nasdaq 100 ETF, they are distributing ETFs, so they will distribute dividends instead of accumulating. And if you prefer accumulating, then we will need to look at Ireland Domiciled UCITS ETF listed in the London Stock Exchange. So moving on to the LSE alternatives, number 1, we have CNDX, iShares Nasdaq 100 UCITS ETF accumulating. And the TER, total expense ratio, is 0.3%. Net assets approximately 28 billion and is Ireland domiciled and is accumulating, so 0.3%. The next option is XNAQ, X-Trackers Nasdaq 100 UCITS ETF, and the all-in fee is only 0.2%. With a total fund assets of around 2 billion Great Britain pounds, and that's around 2.5 billion US dollars. It's Ireland domiciled as well, accumulating. So if you compare CNDX versus XNAQ, you will see that XNAQ stands out there because it is cheaper, 0.2 versus 0.3, while retaining the same Ireland domiciled UCITS structure, but have a 10x smaller AUM. So for those of you who are considering liquidity, this may be a concern. And where can you buy all these Ireland domiciled ETF is through Interactive Brokers, which is my preferred choice of broker. So for those of you who want to look at London Stock Exchange, you can either click on this link or you can scan this QR code to find out more about Interactive Brokers. But let's move the discussion even deeper. When we talk about dividend withholding tax, usually when Singaporeans talk about UCITS ETF, which are Ireland domiciled, is the main reason being withholding tax, and because you can save 15% of that. But you see the Nasdaq, it has a relatively low dividend yield, less than 0.5% based on QQQ data sheet. And you look at it, 15% withholding tax savings multiplied by 0.5%, that is like 0.075% per annum that you will see, which is very modest and is comparable to the size of the expense ratio gap between all these funds. So the tax benefit, it exists, but it's not really the main reason to pick a UCITS ETF in this particular index. Unlike the S&P 500, which is giving you around 1% dividend yield, there is much lesser withholding tax savings that you could save if you switch to a UCITS fund for Nasdaq. While the US estate tax consideration still doesn't change because US listed ETFs such as QQQ, QQQM, QNDX or IQQ, they are all US domiciled. So for non-US citizens and US residents like us, once the US domiciled assets exceed $60,000 at death, then it can be taxed up to 40%, which is not ideal. And that's where CNDX and XNAQ, or Ireland domiciled, generally used by non-US investors specifically to sidestep these estate tax issues. And for a Singaporean building a large long-term Nasdaq 100 position, this matters more than saving the 0.05% to 0.1% in fees. But I want to highlight that tax rules can change, so anyone with a substantial portfolio should get proper estate and tax advice and not consider this video as financial advice because this is just facts that I presented. And if you forget everything I said, I put all these stickers and their facts sheet onto a summary cheat sheet that you can download from my coffee shop. Okay, no need to pay me anything, it's for free download. But if you want to support the channel, I will appreciate you to click the IBKR link or scan the IBKR QR code. And I get a small commission for every click I receive. So thank you to those who have clicked or scanned. So now, after comparing all these ETFs between the US and the UK listed ones, which one is the best? I would say that each one fits a different profile. If you like active trading, like you do options, then QQQ for the deepest liquidity and options ecosystem. Now, if you like an established US listed option that has at least been 5 years, then QQQM because it is cheaper than QQQ with a multi-year track record. Now, the cheapest US listed options is QNDX at 0.1%, but you need to be mindful of its smaller AUM and liquidity. And the best new alternative from a major provider, that's IQQ, 0.1% for now until July 2027, and it's even larger than QNDX. So if you look at Ireland domicile options, you have XNAQ at 0.2%, cheaper than CNDX while addressing the estate tax exposure. So if you ask me honestly, if I were to compare all these ETFs, a smaller portfolio where estate tax isn't a concern, I think QQQM remains quite a sensible established choice. But you can also go for QNDX, which is lowest cost pick for those comfortable with a brand new fund. And for a Singaporean building a Nasdaq 100 position that could eventually become substantial, my overall preference is XNAQ. Now, despite it being slightly higher expense ratio at 0.2%, but it is accumulating. It is Ireland domiciled, and the dividend tax angle here is minor compared to the estate tax angle that could expose you to all these issues when you die. But the bigger decision isn't whether you pay 0.1% or 0.2%. It's whether this concentrated, growth-heavy exposure portfolio really fits your overall portfolio in the first place. So you really have to think about whether Nasdaq 100 fits your portfolio allocation. And I know I've gone through the S&P 500, I went through the World ETF, and now I completed Nasdaq. So naturally, next one I should talk about is the Straits Times Index for our home market. So comment STI if you want my next ETF comparison on the Straits Times Index. And if you haven't watched my previous video on an all-world ETF or global diversification, what are the best ETF that you can look at, then you can refer to this video right here.